On March 9, 2009, the stock market was bleeding out. The S&P 500 had collapsed to 676. Pension funds were gutted. Retirees were going back to work. And then, something nobody expected happened. The market didn't just recover. It launched into the longest bull run in American history. For 11 straight years, stocks went up. The S&P climbed from 676 all the way to 3,386 by February of 2020. That's nearly a 400% gain. $10,000 invested at the bottom became almost $52,000. But here's what most people get wrong about that decade. They think it was easy money. It wasn't. And the third lesson is the one most investors are still ignoring today. Let me take you back to early 2009. Lehman Brothers had collapsed. Bear Stearns was gone. The financial system was on life support. And every front page screamed the same word, depression. The S&P had lost 57% of its value in 17 months. Half of America's retirement savings gone on paper. Warren Buffett wrote his now famous op-ed in October 2008. The headline? Buy American. I am. People thought he was crazy. The smart money was running for the exits. But Buffett saw what others couldn't: when the price collapses faster than the underlying value, that's not a crisis. That's a sale. And here's the part most investors miss. The bull market didn't start when things got better. It started when things were still terrible. In March 2009, unemployment was climbing toward 10%. Banks were still failing. And stocks started going up. So what fueled this incredible 11-year climb? 3 forces. And understanding them changes how you see today's market. First, the Federal Reserve cut interest rates to near zero. For the first time in modern history, savings accounts paid almost nothing. So where did money go? Into stocks. Into real estate. Into anything that could earn a return. Second, corporate earnings recovered faster than anyone expected. Companies had cut costs to the bone during the crisis. When demand came back, profit margins exploded. By 2015, S&P 500 earnings had more than tripled from their 2009 low. Third, and this is the big one, a handful of technology companies rewrote the rules of compounding. Apple went up roughly 1,300%. Amazon, 3,400%. Netflix, 7,400%. If you'd put $10,000 in Netflix at the bottom and just held it, you'd have about $750,000 by 2020. But here's where it gets interesting: most people who owned these stocks didn't actually capture those returns. Why? Because they kept selling on the way up. This is where the real education begins. Studies of investor behavior during this period revealed something painful. The average investor earned just 5 to 6% annually, while the index itself returned over 13%. How is that possible? Because investors panicked. There were 5 separate corrections of 10% or more during the bull market. The European debt crisis in 2011. The China scare in 2015. The taper tantrum. The Brexit shock. The volatility spike of early 2018. Each time, the headline screamed, "This is it, the bull market is over." Each time, investors sold near the bottom. And each time, they bought back in higher. Sound familiar? There's an old market saying. The market is a device for transferring money from the impatient to the patient. That decade proved it. The people who simply bought a low-cost index fund and went to sleep, they crushed the so-called experts. Now, here's the uncomfortable truth about long bull markets. The longer they run, the more dangerous they become. Not because they have to end, but because investors forget what risk feels like. By late 2019, 3 warning signs were flashing. First, valuations. The Shiller P/E ratio, a measurement of how expensive stocks are relative to their long-term earnings, had climbed to 31. The historic average is around 16. We were paying nearly double the long-term price for $1 of earnings. Second, margin debt was at record highs. People were borrowing against their portfolios to buy more stock. This is what happens at every market top. From 1929 to 1999 to 2007, it always rhymes. Third, money was pouring into companies that had never made a profit. The same pattern Benjamin Graham warned about in 1934. Speculation dressed up as investing. And then, in February 2020, a virus most Americans hadn't heard of started spreading. The bull market that had defied every prediction for 11 years died in 33 days. The S&P fell 34%. The fastest bear market in history. Here's what 11 years of rising markets actually taught us. The greatest returns went not to the smartest investors or the fastest. They went to the ones who could simply sit still. Who bought good businesses? Who ignored the noise? And who understood that volatility is the price of admission, not a reason to leave the theater? The bull market ended. The lesson didn't. Here's my question for you. If you were investing during that decade, did you hold on? Or did one of those scary headlines shake you out? Tell me in the comments. I read every one. And if this gave you a new way to think about market history, hit subscribe. Tomorrow, we're looking at something controversial: why the next bull market may already be hiding in plain sight. Remember, this is educational content, not financial advice. Always do your own research before investing.